Ladies and gentlemen, something important just changed, and most investors haven't connected the dots yet. The Federal Reserve's latest signals aren't just about interest rates, they're about the direction of the entire financial system. Whenever monetary policy shifts, money moves. And when money moves, gold and silver often become part of the conversation. But here's the mistake many people make. They react emotionally instead of strategically. Today, we'll break down what the Fed's latest move really means, what history suggests could happen next, and why disciplined investors are paying close attention. The Federal Reserve has once again reminded the market that monetary policy is never static. It evolves with the economy, and every adjustment sends signals that reach far beyond Wall Street. The headlines usually focus on one number, whether interest rates moved up, down, or stayed the same, but experienced investors know that's only part of the story. The real message is found in the language, the projections, and the balance between confidence and caution. Markets don't simply react to what the Fed does today. They react to what participants believe the Fed will do tomorrow. When central bankers begin changing their tone, investors should pay attention, but they should also avoid overreacting. Financial markets have a habit of taking one statement and turning it into an extreme narrative. One day, everyone believes rates will stay high forever. The next day, they're convinced aggressive cuts are just around the corner. Reality is usually much more balanced. Economic transitions are rarely clean, and policy decisions are almost always based on incomplete information. That's why disciplined investors spend less time trying to predict every meeting and more time understanding the broader direction of the economy. The current environment is a reminder that inflation, employment, consumer spending, and business investment remain deeply interconnected. The Federal Reserve has to weigh all of these forces simultaneously. If inflation shows signs of cooling, policymakers gain more flexibility. If growth begins to weaken, they may become more supportive. If inflation remains persistent, they may choose patience. None of these decisions happen in isolation. Every adjustment influences borrowing costs, corporate investment, consumer confidence, and ultimately the pace of economic activity. One of the most important variables investors should watch isn't just the level of interest rates, but the direction of expectations. Markets continuously price future possibilities. Asset prices often move months before economic data confirms what investors suspect. That's why expectations matter as much as actual decisions. A subtle shift in language can influence bond markets, equity valuations, currency movements, and capital flows around the world. Financial markets are forward-looking mechanisms, and they constantly attempt to discount tomorrow's conditions rather than today's headlines. Higher interest rates generally tighten financial conditions. Borrowing becomes more expensive for households and businesses, capital becomes more selective, and investment decisions require greater discipline. Lower rates can have the opposite effect, encouraging lending, investment, and risk-taking. But neither environment guarantees success or failure. Strong businesses can continue investing during difficult periods because they focus on long-term value creation instead of short-term market sentiment. Investors should apply the same mindset to their own portfolios. The strength of the US dollar also plays an important role in the broader financial picture. Monetary policy influences currency markets because differences in interest rates affect where global capital seeks returns. When investors anticipate relatively higher returns in dollar-denominated assets, capital often flows toward the United States. When those expectations change, money may begin flowing elsewhere. These shifts don't happen overnight, but they can gradually reshape global investment patterns. Understanding these relationships provides much more insight than simply following daily market fluctuations. Bond markets deserve just as much attention as stock markets. Treasury yields influence everything from mortgage rates to business financing costs. They also serve as benchmarks for valuing nearly every major asset class. When yields move significantly, investors reassess risk, expected returns, and future economic growth. Sometimes equity markets celebrate falling yields because financing becomes cheaper. Other times, declining yields reflect concerns about slowing growth. Context always matters more than a single market movement. Business leaders also pay close attention to financial conditions because capital allocation decisions depend heavily on them. Companies considering major investments, acquisitions, hiring plans, or infrastructure projects evaluate financing costs carefully. Small changes in borrowing costs can influence billion-dollar investment decisions. This is why Federal Reserve policy eventually reaches every corner of the economy, from multinational corporations to local businesses and individual consumers. It's also worth remembering that uncertainty is a permanent feature of investing. Every economic cycle brings new challenges that seem unprecedented in the moment. Financial crises, inflation shocks, technological disruption, geopolitical events, and changing consumer behavior all influence markets in different ways. Yet history consistently shows that economies adapt, businesses innovate, and investors who remain disciplined generally position themselves better than those who react emotionally to every headline. This is where experience becomes valuable. Markets often reward patience more than prediction. Many investors spend enormous energy trying to forecast the exact timing of policy moves, but fewer spend time building resilient portfolios capable of performing across multiple economic scenarios. Diversification, strong balance sheets, healthy cash flows, and reasonable valuations remain important regardless of where interest rates move next. Good investing isn't about always being right, it's about being prepared for different outcomes. Another mistake investors frequently make is assuming every policy shift immediately transforms the economy. Monetary policy operates with delays. Decisions made today may take months or even longer to fully influence business investment, employment, consumer spending, and inflation. That's why short-term market volatility shouldn't always be interpreted as confirmation that a long-term trend has changed. Markets can overshoot in both directions before fundamentals eventually reassert themselves. Confidence should never become complacency, and caution should never become paralysis. Successful investors recognize that uncertainty creates both risks and opportunities. Instead of asking whether every Fed announcement is bullish or bearish, they ask deeper questions. How are financial conditions changing? What does this mean for business investment? How might consumers respond? Where is capital likely to flow over the next several quarters rather than the next several days? The biggest advantage any investor can develop is perspective. Economic cycles come and go. Monetary policy changes. Markets experience periods of optimism and pessimism. Through all of it, disciplined decision-making remains remarkably consistent. Investors who understand the relationship between interest rates, economic growth, inflation, capital flows, and market psychology are better equipped to navigate uncertainty than those who simply react to headlines. The Federal Reserve's latest shift is significant not because it guarantees a particular market outcome, but because it offers another important signal about the evolving economic landscape, and understanding those signals is where long-term opportunity often begins. Gold and silver have occupied a unique place in financial markets for generations because they respond to forces that extend far beyond simple supply and demand. They sit at the intersection of economics, monetary policy, investor psychology, industrial activity, and global confidence. When the broader financial landscape begins to shift, these metals often attract renewed attention, not because they are guaranteed to outperform, but because they reflect how investors assess risk, purchasing power, and long-term value. One of the most important drivers is confidence in the future direction of the economy. When growth appears stable, inflation is under control, and financial markets are functioning smoothly, investors often allocate more capital toward productive assets such as businesses and equities. But when uncertainty increases, whether because of changing monetary conditions, slower growth, or heightened market volatility, investors tend to reassess the balance of their portfolios. That reassessment frequently includes a closer look at precious metals. Gold has traditionally been viewed as a long-term store of value. Unlike financial assets that depend on the earnings of a company or the creditworthiness of a borrower, gold carries no promise of future cash flows. Its value is tied to scarcity, durability, and the confidence that people around the world place in it over long periods of time. That characteristic has allowed it to remain relevant through changing political systems, economic cycles, and financial crises. Silver occupies a more complex position. It shares many of gold's monetary characteristics, but it also plays an important role in modern industry. It is used in electronics, renewable energy technologies, medical equipment, advanced manufacturing, and numerous industrial applications. That dual identity means silver often responds to two different forces at the same time. It can benefit from investor demand during periods of uncertainty, while also being influenced by changes in industrial production and technological development. The relationship between precious metals and interest rates deserves careful attention. Investors are not simply watching whether rates are high or low, they are evaluating the broader financial environment. Expectations surrounding inflation, economic growth, and future monetary policy all influence how capital is allocated. When markets begin anticipating changes in financial conditions, investors often revisit assets that may provide diversification across different economic scenarios. Currency movements also play a meaningful role. Because gold and silver are widely traded in US dollars, changes in the dollar's strength can influence international demand. A stronger dollar can make precious metals more expensive for buyers using other currencies, while a weaker dollar may improve affordability for global investors. Of course, currency markets are influenced by many factors, including economic performance, interest rate expectations, trade balances, and geopolitical developments, making this relationship dynamic rather than mechanical. Another factor shaping the outlook is the behavior of central banks around the world. In recent years, many central banks have maintained significant interest in gold as part of their reserve management strategies. Their decisions are not driven by short-term price movements, but by long-term considerations involving diversification, reserve stability, and financial resilience. While central bank activity alone does not determine market prices, it represents another important element within the broader demand picture. Market psychology can amplify these trends. Financial markets rarely move in perfectly rational ways over short periods. Optimism can become excessive, just as fear can become overwhelming. Precious metals often become part of these emotional swings because they represent safety to some investors and opportunity to others. Experienced investors understand that emotions create volatility, but they also recognize that volatility should not replace disciplined analysis. Silver introduces another interesting dimension because industrial demand continues evolving alongside technological innovation. Expanding investment in renewable energy infrastructure, advanced electronics, electrification, and other high-tech industries has increased attention on materials essential to these sectors. Industrial demand can strengthen independently of monetary factors, creating periods when silver responds differently than gold. This combination of financial and industrial influences makes silver one of the more complex commodities to evaluate. Supply dynamics deserve equal consideration. Expanding production is not always straightforward. Developing new mining projects requires significant capital, regulatory approvals, environmental reviews, infrastructure investment, and years of planning before meaningful production reaches the market. As a result, supply often responds more slowly than demand, especially during periods of rapidly changing market conditions. Investors monitoring precious metals should evaluate both sides of the equation rather than focusing exclusively on demand. Global uncertainty remains another variable that can influence investor behavior. Trade disputes, geopolitical tensions, fiscal challenges, and financial market instability periodically remind investors that risks rarely disappear entirely. Markets are resilient, but they are also interconnected. Events occurring in one region can quickly influence investor sentiment worldwide. During such periods, diversified portfolios often receive renewed attention, and precious metals may become one component of broader risk management strategies. At the same time, it's important to avoid assuming that every positive development for gold automatically translates into identical performance for silver, or vice versa. Although the two metals often move in the same general direction, they can diverge significantly depending on industrial activity, manufacturing demand, investor positioning, and broader commodity market trends. Understanding those differences is essential for making informed investment decisions. Long-term investors also recognize that timing markets consistently is extraordinarily difficult. Precious metals, like all asset classes, experience periods of strong performance as well as extended periods of consolidation or decline. Building investment decisions solely around short-term headlines often produces disappointing results. A more durable approach involves understanding why an asset may serve a particular role within a diversified portfolio rather than expecting immediate gains. Another lesson worth remembering is that no single asset solves every investment challenge. Strong portfolios typically combine different types of assets that respond differently under varying economic conditions. Equities may benefit from expanding economic growth. High-quality fixed income may provide stability during slower periods. Cash offers flexibility. Precious metals can contribute diversification under certain circumstances. The objective is resilience, not dependence on a single outcome. Financial history consistently demonstrates that economic cycles evolve rather than repeat exactly. Every cycle has unique characteristics, but familiar principles continue to matter. Prudent risk management, disciplined capital allocation, and careful attention to changing macroeconomic conditions. Investors who understand these relationships are better positioned to evaluate opportunities objectively instead of reacting impulsively to market excitement. As financial conditions continue evolving, gold and silver may attract greater attention because they sit at the crossroads of monetary policy, inflation expectations, industrial demand, currency movements, and global confidence. Whether that attention ultimately translates into sustained price appreciation will depend on a combination of economic forces rather than any single event. The most successful investors understand that lasting opportunities are rarely created by headlines alone. They emerge when careful analysis, patience, and disciplined decision-making align with broader structural trends unfolding across the global economy. Every market cycle creates a fresh set of headlines designed to capture attention. One day, the narrative is built around inflation, the next around interest rates, then economic growth, geopolitical events, corporate earnings, or financial stability. Each story arrives with a sense of urgency, encouraging investors to believe that immediate action is the only rational response. Yet history consistently shows that the biggest investment mistakes are often made not because people lack information, but because they allow short-term emotion to overpower long-term discipline. Successful investing has never been about reacting to every headline. It has always been about understanding what truly changes the long-term outlook and what simply creates temporary noise. Markets are highly efficient at processing new information, but they are also influenced by fear, optimism, speculation, and momentum. These emotional forces can push prices well above or below levels justified by underlying fundamentals. Investors who recognize this dynamic are better equipped to avoid decisions they may later regret. One of the most valuable habits any investor can develop is separating events from trends. An event happens in a single day. A trend develops over months or years. Financial television, social media, and market commentary naturally focus on events because they create immediate interest. Long-term wealth, however, is usually built by recognizing trends before they become obvious and remaining patient while those trends develop. That requires discipline, not excitement. Economic conditions rarely move in straight lines. Growth accelerates, slows, and recovers. Inflation rises and falls. Consumer confidence strengthens and weakens. Businesses expand, adjust, and innovate. These shifts are normal features of economic cycles rather than signs that the entire financial system is changing overnight. Investors who understand this are less likely to confuse temporary volatility with permanent change. Patience is frequently underestimated because it lacks the excitement associated with making bold predictions. Yet patience is one of the greatest competitive advantages in investing. Markets reward those who can remain focused while others become distracted by daily fluctuations. The temptation to constantly buy, sell, or reposition portfolios often feels productive, but excessive activity can increase costs, create unnecessary tax consequences, and encourage emotional decision-making rather than thoughtful analysis. Risk management deserves just as much attention as return potential. Many investors spend enormous amounts of time searching for the next winning investment while spending relatively little time considering what could go wrong. Experienced investors approach every opportunity by evaluating both upside and downside. They recognize that preserving capital during difficult periods provides the flexibility to take advantage of future opportunities when conditions improve. Diversification remains one of the most practical tools available for managing uncertainty. No one consistently predicts economic turning points, policy changes, geopolitical developments, or market reactions with perfect accuracy. Building a portfolio that can perform across multiple scenarios is often more valuable than attempting to forecast a single outcome. Different asset classes respond differently to changing economic conditions, and that balance helps reduce the impact of unexpected events. Another important principle is understanding the difference between volatility and risk. Volatility refers to price movement, which can be uncomfortable but is not necessarily permanent. Risk involves the possibility of permanently losing capital because of poor investment decisions, excessive leverage, weak fundamentals, or inadequate diversification. Too many investors confuse these concepts. Temporary market declines can create attractive opportunities for disciplined investors, while apparently stable investments with weak underlying economics may carry substantial long-term risk. Financial markets have repeatedly demonstrated that confidence can shift rapidly. Periods of extreme optimism are often followed by greater caution, while moments of widespread pessimism frequently create opportunities that only become obvious in hindsight. This doesn't mean investors should attempt to perfectly time every market reversal. Instead, it highlights the importance of maintaining perspective when emotions dominate public discussion. Technology has made information available faster than at any point in history. News reaches investors within seconds, accompanied by endless analysis, opinions, and predictions. While access to information has improved dramatically, the quality of decision-making has not necessarily improved at the same pace. More information does not automatically produce better judgment. In many cases, filtering out unnecessary noise becomes just as valuable as gathering new data. Business leaders face similar challenges. Every major company operates in an environment filled with uncertainty. Consumer preferences evolve, competitors innovate, regulations change, and global events influence operations in unexpected ways. Successful businesses rarely change their long-term strategy because of one difficult quarter or one surprising headline. They adapt thoughtfully while remaining focused on long-term objectives. Investors can benefit from applying the same mindset to their own portfolios. Another lesson worth remembering is that forecasting is inherently difficult. Even highly experienced economists, analysts, and market professionals regularly disagree about the direction of inflation, growth, interest rates, and financial markets. That disagreement reflects the complexity of the global economy rather than a lack of expertise. Investors should approach forecasts with humility, recognizing that uncertainty is permanent and flexibility is essential. Discipline also requires emotional control. Fear often encourages investors to sell after markets have already fallen significantly. Excitement encourages buying after prices have already risen substantially. Both reactions are understandable, but they can undermine long-term performance. A disciplined investment process establishes clear objectives before emotions become involved. Decisions grounded in analysis generally produce better outcomes than those driven by urgency. Long-term opportunity often emerges during periods when uncertainty feels greatest. Businesses continue developing new products, improving productivity, expanding into new markets, and creating value regardless of temporary market sentiment. Economic progress is rarely smooth, but innovation and entrepreneurship have consistently driven long-term growth across decades. Investors who maintain exposure to these broader trends are often rewarded for their patience. It is equally important to remain intellectually flexible. Discipline does not mean ignoring new information or refusing to adapt. Strong investors continuously evaluate changing conditions, test their assumptions, and adjust when evidence supports doing so. The key difference is that adjustments are based on careful analysis rather than emotional reaction. Flexibility grounded in evidence is a strength, while impulsiveness driven by headlines is often costly. Perhaps the most enduring lesson is that investing is a marathon, not a series of isolated sprints. Individual headlines fade quickly, but the decisions made during periods of uncertainty can influence financial outcomes for years. Investors who remain focused on quality, diversification, sound risk management, and long-term economic fundamentals place themselves in a stronger position regardless of how the next few weeks or months unfold. Markets will continue generating dramatic headlines because uncertainty is an unavoidable feature of investing. Some predictions will prove accurate, many will not, and new narratives will always replace old ones. The investors who consistently succeed are rarely the ones making the boldest forecasts. They are the ones who remain disciplined when others become emotional, who distinguish lasting trends from temporary distractions, and who understand that long-term opportunity is built through patience, thoughtful analysis, and consistent decision-making rather than constant reaction.